£1 billion. That's the charge British bank Lloyds has taken to compensate customers' missold loan insurance. A large chunk of change? Most certainly. But investors shrug it off and Lloyds shares surge over 6%. I'm Jamie McGeever and this is today's Market Pulse. Well, I'm joined now by Alpari Chief Market Analyst James Hughes. James, £1 billion hit for Lloyds. Total charges over £5 billion, yet the shares are their highest since August last year. What's going on here?
Yeah, I mean, it's not often you see a share price start to, or traders start to shrug off a £1 billion add-on to what is already a pretty hefty charge. But I think we have seen that in the market so far today. I mean, it hasn't all been negative within these Lloyds numbers, and I think that's the first thing to get. OK, adding £1 billion onto this, and for this overall charge could end up being around £5.5 billion. That is a massive amount, and of course these PPI investigations are continuing. I'm sure we haven't heard the end of it or the end of these being increased, but within the statement there were a few more positive notes. Of course, Lloyds have been through a pretty aggressive cost-cutting plan as well, and what we're seeing is cost-cutting now actually starting to affect the bottom line. I mean, Lloyds have got rid of over almost 5,000 staff, so I mean that one thing alone is starting to affect the bottom line. But the thing is, this distorts what the market's after. Of course, we want to see growth in companies. We want to see strong quarters and strong profits, of course, but we don't want to see them on the back of aggressive cost cutting. And I think, of course, we've been through a tough time recently. We've seen a lot of companies getting these cost cutting plans, and it takes us back to almost sort of 3 years ago, when we were talking about these. We didn't want to see these heavily cost cutting plans, meaning that we get strong quarterly earnings. We want to see proper growth in these companies.
So, are you suggesting then that if we can talk in general terms for the banks, are banks a sell on rallies as opposed to a buy on dips?
Yeah, I think they are. They do tend to be, because there's a lot of unknown around them. Of course, a lot of these banks are still trying to repair damaged reputations, and some of them damaged irreparably. So there's some huge issues going on in the banking sector. I mean, you look even UBS stories this week in the investment banking. They're getting rid of 1,000 people within the next few weeks. 4,000 in the UK, over 10,000 globally. So investment banking isn't performing that well. Volume has been low in the market. So investment banks have struggled. And retail banks aren't doing that. Have never had that turnaround where things start to get that little bit more positive. So overall, I think there is a lot more negativity and uncertainty over this PPI stuff for retail banks to come. OK, well, if we can say banks are perhaps a sell on rallies, are energy and commodity companies a buy on dips? I mean, today we've had Glencore and Shell, not too bad. BP and Total this week. Would you be advising clients to buy on these dips? Yeah, I mean, I think you're looking a lot more positive over these than you are in terms of banks. I mean, Shell and the oil companies are always strange ones because they rely so heavily on, of course, the oil prices, and oil and gas prices have fallen. We've almost seen oil prices fall almost 20% over the last 3 months or so. So there's been big movements in oil prices, which always hit the bottom line of these oil companies, and it's usually, we're talking the other way around, strong performances for Shell and BP on the back of strong oil prices. Of course, we've got the inverse of that at the moment. Glencore's a different one. I mean, expected Glencore to be higher, trading a little bit higher today. They're not doing that much in terms of share price, but I think you've seen strong performances and production in a lot of their mines, even though they've had quite a lot of issues with strikes and power cuts in the likes of Congo. There's still some real strong movements coming out of there, and what they're talking about, their marketing arm, which is actually their trading arm, that's been the area that last year saved them. Was almost 70% of their profits came from this trading arm of their company. And again, this quarter we've seen the positivity there. So again, there are a lot more positive tones in what's going on in sort of the commodity, oil and gas, and this sort of sector than there are in the financials and the banking.
Great stuff, James. Thank you very much. Well, the UK's latest manufacturing PMI numbers under the macroscope today. The headline number slides to 47.5. That's down from a revised 48.1 in September and lower than the 48 forecast by economists. The decline likely to reignite debate over further stimulus from the Bank of England. Such talk had been cooling off after last week's GDP figures showed the country returning to growth in the third quarter. And the FTSE is up 0.7% today and cable at a 2-week high. Well, that's all from us for now, but do join us every day at this time for a look at what's moving on markets and why. I'm Jamie McGeever. This is Reuters.